welcome back to the Explainer. So glad you're here. Look, this week we're unpacking a really fascinating paradox in the global financial markets. We literally saw massive spikes in energy prices, very real geopolitical tensions, and shifting interest rate expectations. But somehow, major markets actually climbed higher. I mean, it's the ultimate financial puzzle, right? Markets going up despite an absolute backdrop of global chaos.
So, the huge question we've got to answer today is how on earth did the stock market rally while the rest of the world felt so incredibly chaotic? It's kind of like a mystery waiting to be solved. Most weeks, we have one dominant story. But this week, we had several conflicting narratives just battling it out for dominance. To actually wrap our heads around how the market survived this, we really need a good way to visualize it. Think of the stock market as a ship, and all that broader global instability as a raging storm. Those crashing waves out there, those represent the oil shocks, the inflation fears, and all those geopolitical risks just trying to capsize the vessel. But here's the thing. A ship survives a storm if its hull is strong enough. In our explainer today, corporate earnings and solid economic data act as that sturdy hull, basically keeping the market afloat when all logic suggests it really should be sinking.
Okay, here's our quick roadmap for the week. We're going to start with our ship in a storm, looking at U.S. equities. Then we'll check in on the global fleet, from London to Tokyo. After that, we dive into the energy sector shockwave, weigh equities against the gold standard, and finally, look ahead to navigate the horizon. Let's get into it. Moving right into our first act, a ship in a storm. Let's see exactly how U.S. equities managed to hold fast.
All right, let's start with this formidable number right here, 7,209.01. That is exactly where the S&P 500 closed out the week. It started at 7,173.91, which basically means it absorbed every single piece of negative news thrown at this week and still managed to carve out a sturdy 0.5% gain. Now, it didn't completely explode upward, sure, but the very fact that it grew instead of sinking, that is absolutely the real headline here.
Notice the direct confrontation between our two main market forces. The crashing waves were super real. I mean, oil-driven inflation risks were just battering investor sentiment all week long. But they met a remarkably sturdy hull. We saw strong U.S. GDP growth reported at 2.0% for the first quarter, alongside incredibly low jobless claims and really resilient corporate earnings. So for this week at least, the hull proved a lot stronger than the storm. Now, it's worth noting that not every part of the ship performed exactly the same way. The Dow Jones was definitely the strongest, jumping 1.0% to over 49,600, and that was heavily lifted by industrial giants. Think companies like Caterpillar really proving their earning power. Meanwhile, the Nasdaq took a bit of a breather, finishing almost flat at 24,892.31. Why? Well, investors started getting a little jittery about the massive ongoing AI-related spending from the major tech companies. So the tech engines kind of slowed down, but the industrial engines kept the whole ship moving forward. Let's shift our focus across the oceans for Section 2, London rises, Tokyo pauses, to check on the rest of the global fleet. Check out the divergent performance of the major indices this week. Visually, it's a stark contrast. You've got the US S&P 500 and London's FTSE 100 climbing the ladder side by side, both gaining roughly 0.5%. But then look over at Tokyo's Nikkei 225, sliding down 2.1%. It's the exact same global macro storm, but completely different outcomes. Let's dig into why. So London didn't just survive the storm, it actually figured out how to surf it. The FTSE 100 closed up at 10,378.82. The secret sauce here is really London's structural makeup. The index has massive exposure to energy, commodities, and global businesses. So when you get strong corporate results from heavyweights like Rolls-Royce and Glencore, and combine that with the Bank of England holding interest rates steady, it provides immense buoyancy. Basically, when commodities surge, London tends to rise right along with them. Tokyo, on the other hand, definitely took on water. The Nikkei fell pretty significantly, dropping from over 60,500 down to 59,284.92. And we can trace this back to three specific triggers. First, just plain old profit-taking. The index had just crossed massive historical highs, so a pullback was supernatural. Second, Japan is a major energy importer, so those oil worries weighed heavily on sentiment. And third, currency struggles. We saw reports of intervention leading to a strengthening yen, which actually hurts Japanese exporters because their overseas earnings become way less valuable when they convert them back to the local currency. Okay, let's dive right into the eye of the storm for Section 3, the energy sector shockwave.
Make no mistake, oil was absolutely the most intense macro story of the week. Look at this massive figure, $126.41. That was the staggering intraday high for a barrel of Brent crude. This sudden, dramatic spike was driven almost entirely by fear, specifically ongoing concerns around supply disruptions in the Middle East and that critical shipping lane, the Strait of Hormuz. But then, an incredibly sharp snapback. Brent crude settled all the way back down near $114.01. I mean, that is a massive intraday reversal, and it brilliantly illustrates a key takeaway, just how extremely sensitive the energy markets are right now. Traders were literally pricing in absolute worst-case scenarios, and when those didn't immediately happen, that fear premium just vanished into thin air.
Now, why should you care about this volatility? Because oil spikes don't just happen in a vacuum. They create a massive ripple effect. When a barrel of oil surges, it instantly increases the baseline costs for, well, everything. Transportation, the food on your table, airline tickets, global shipping, the whole shebang. That is exactly why oil remains the primary engine behind these resurfacing inflation fears. Even if the stock market is rallying, oil is this sleeping giant that could wake up at any moment and totally wreck the party. So, with all that going on, where did investors hide? Let's transition to Section 4, Equities versus the Gold Standard, and look at the search for safe harbor. Notice this stark contrast between our quote-unquote risky and safe assets this week. Normally, you'd expect stocks to be totally erratic and gold to be rock steady during a global crisis, right? Well, we saw the exact opposite. U.S. equities were the steady performers, climbing that 0.5% on the back of solid earnings. Meanwhile, gold, the ultimate traditional safe haven, was surprisingly erratic and is actually heading for a second straight monthly decline. Who would have thought? The real micro-narrative here is that gold is just deeply conflicted right now. While fear and geopolitical risk naturally drive people toward it, gold is fighting a totally losing battle against high interest rates. Remember, gold is a non-income producing asset. When interest rates are this high, you can make a guaranteed return just holding cash in a bank. So holding a shiny piece of metal that pays zero yield, it becomes a lot less attractive, no matter how scary the world gets. And we see this pressure building across all speculated assets. Spot gold did manage a bit of a Thursday rebound to $4,618.67, but it remains structurally pressured. Silver recovered slightly to $73.70 an ounce, but because it's also heavily used in industry, fears of an economic slowdown are holding it back. And crypto? It stayed super cautious, failing to show any real upside momentum, with Bitcoin slipping to $76,321. The simple truth is, when money is expensive to borrow, liquidity dries up and speculative assets just struggle to catch a tailwind. All right, let's move to our final section, Navigating the Horizon, to synthesize everything we've learned into exactly what you need to watch next. As we look toward Friday's trading session, the market's direction really won't depend on one single number. It's going to come down to these four key variables. First, oil. Does it stabilize around that $114 mark, bringing some calm, or does it spike right back toward 126? Second, earnings. Can these major companies continue proving that their financial holes are totally watertight? Third, inflation. Are investors going to bid up bond yields because they think this oil shock is permanent? And finally, currency. How will Japan's intervention with the yen continue to shake up global exchange rates? Which brings us to our final overarching thought for the week. The markets have proven time and time again that they absolutely want to rally when corporate fundamentals are strong. But those energy and geopolitical threats, they are very real. So, the ultimate question going into the end of the week is this. Will investors maintain their focus on the sturdy ship of strong earnings, or will they inevitably be forced to refocus on the crashing waves of global risk? Keep your eyes on those four variables, and we will find out together. Thanks so much for joining me on The Explainer, and I'll catch you next time.